Hello everyone and welcome to this virtual investor event hosted by NZX. My name is James Sharp. I sit on the origination team at the exchange, joining you as I am this morning from quite a nice and sunny Auckland, albeit being a very chilly one. I hope everything is all and well where you are joining us from this morning. As ever, this is a chance to hear from three of our listed issuers on the exchange. We're going to hear three presentations, about 15 minutes each. After each of those presentations, there'll be an opportunity to ask questions. Any questions we don't get to, we shall endeavour to get some answers over to you after today's session. To ask a question, please do so via the text box in the webinar panel. It's an anonymous Q&A, so do send those through. Yeah, let's crack into it. So first up, I'm delighted to welcome AJ Smith and Andrew Balgarnie, respectively the CEO and CSO of TradeWindow. TradeWindow provides the tools and support for exporters, importers, freight forwarders and customs brokers to move away from inefficient trade processes and begin the journey to digital transformation. Given NZ's reliance on international markets, particularly interested to hear from AJ and Andrew and what they've been building at TradeWindow. So AJ, Andrew, over to you, and I'll be back in a few moments with some questions. Thank you.
Thank you, James, and good morning, and thank you for joining today. On the left-hand side is Andrew Balgarnie, our CSO, and I'm AJ Smith, CEO and founder of TradeWindow. Before we start, I'd just like to bring the disclaimer to your attention. I also note that all of the comparisons in the presentation are for the 12 months to 31st March 2022, unless otherwise stated. I'll start with an overview of the financial results and a strategic progress as we have occurred. Andrew will speak to the market opportunity as well as provide an update to the progress against our strategy. I'll finish with an outlook then for year 2024, and at the end we'll have some time for some questions. So we'll start on slide 4. We are very pleased with the strong growth in the trading revenue, up 27% to 4.9 million. This is highly principally the result of strong organic growth as exporters, importers and freight forwarders embrace the digital trade and select our solutions. Organic growth was particularly strong in the final quarter of 2023. Revenue growth reflected increased sales across all of our products, including Cube, and Cube is the cornerstone of our global trade platform, and which delivered 341% revenue growth increase. The result also reflects the full year impact of prior acquisitions of Speedy and Refider, which is now called TradeWindow Assure, and this trading revenue was up 17%. The total income was at 5.7 million, and that was up 18%. Both trading revenue and total income were within the revised guidance ranges. In March, we also announced the cost reductions, which included a 27% reduction in FTE roles, to put the business on a more sustainable footing as we balance growth, profitability, and available funding. These were difficult but necessary decisions. The right sizing of the cost base will be visible in our next financial year, 24. Our comprehensive solutions underpinned by our global trade platform mean we are well positioned to take advantage of the growing opportunities in digital trade in existing and in new markets. We are confirming our guidance for 2024 that we provided in April, and we'll comment on this later in this presentation. If I go to slide 5, as noted already, trading revenue is up 27% from 3.8 million to 4.9 million. Total revenue, which includes government grants, was 5.7, and which is up 18%. During the year, we saw growth in products used by both exporters and importers, with revenue up 23% and by freight forwarders up 36%. During the second half, we implemented new processes to increase the speed of our onboarding, which was an issue earlier. This is to minimize the time between sales conversion and receipt of revenue, as well as improving customer experience. We expect to see this reflected in the improved margin in the next financial year 24. We have also introduced annual recurring revenue and ARR as a more insightful measure of our revenue position on 31st March 2023. ARR is commonly used metric among SaaS businesses, particularly growth ones, to show the projected recurring revenue based on current and recent levels. Because of its focus on current and recent levels as the starting point, it is regarded as a very reliable indicator of expected revenue. ARR is at 5.2 million, which is 39% up on the prior year from 3.7. It is based on the March 2023 subscription revenue, plus the average transactional revenue for Q4 annualized. One of the strengths of TradeWindow's business model is the high percentage of recurring revenue. In financial year 23, as a percentage of trading revenue, recurring revenue was 90%. This was an increase on the 22 year when it was 83%. On this slide, we have included separate measures for monthly average revenue per customer by shippers, being exporters and importers, and freight forwarders. And TradeWindow's average revenue per customer was up 9% for shippers and up 22% for freight forwarders. Overall, customer numbers increased during the period from 454 to 475, and I'll highlight the diversity of our customer base later in the presentation. 93% of our customers retained over the period, and we see a slight decline in customer numbers during the second half, which reflecting closure of smaller freight forwarders during the business year. However, this has been offset by higher value customers and new customers being onboarded during the same period. The percentage of expenses on R&D and commercialization reflected the planned investment program for financial year 23. As mentioned, in March, we implemented plans to reduce cost, which will be visible in the next financial year 24. These cost reductions see us taking a more conservative approach to our R&D investments. On slide 6, I have covered revenue, and so turning to cost now. Total operating expenses were 17.5 million, up 21% from 14.4 million, reflecting the revenue growth and planned investments in market development and the global trade platform. Our EBITDA loss was 11.7 million, up 22% from the 9.5, and our net loss reduced with 10% to 9.8 million. Expenses and EBITDA reflect financial year 23 prior to cost reductions as announced. We believe that financial year 24 will see the continuation of our disciplined approach to operational expenditure while ensuring our targeted investments when necessary to achieve our goal and our outcomes. Moving to the next slide, during the second half, we raised 5.4 million under capital raising at March 31st. Our cash balance was 6.1 million. Our January capital raising occurred in a very challenging funding environment, and we continue to work hard to ensure that necessary funding is in place. Taking into account the cost reductions that's been completed, we anticipate sufficient funding for the financial year 24, and this also excludes any funding that TradeWindow may receive during the financial year 24, including this current deal that we are working on, which is the Enchain transaction. On March 31, we announced a heads of agreement with Enchain. We remain active in the discussions and agreed to the long form and are in the process of agreeing to the long form with Enchain, and we'll keep the market updated on this development. In addition to the Enchain, we remain in discussion with other investors who have been tracking TradeWindow for a while now. I'll now ask Andrew to give us a little bit of a market context and talk about the opportunity, followed with an update on the progress against our strategy.
Thanks, AJ. I'm on slide 9. You'll see the sheer complexity of the global trade system and the network of organisations which make up global supply chains. The sharing of data underpins all activities in this network, whether forming a sales agreement, coordinating the physical movement of goods, or even making a payment. Turning to the next slide, many organisations still rely on manual paper-based processes to facilitate the exchange of information. Boston Consulting Group illustrate the scale of the issue. A single shipment can require the preparation of up to 10 to 20 paper documents, which in aggregate contain approximately 5,000 data points. This archaic approach to trade leads to a significant amount of waste, with the data being manually entered into supply chain systems at every step, and this being exporters, importers, ports, ocean carriers, border authorities, banks, insurance companies, and more. Paper-based processes expose businesses to risks of human error, theft, or fraud. On slide 11, you can see that the digitalization of global trade is being driven by 3 major trends: macroeconomic, customer demand, and market enabling. Market forces are converging to create the perfect environment for widespread adoption of digital trade solutions. Macroeconomic trends, including continued supply chain disruptions, inflation, and the global skill shortages, are pushing businesses in all countries to be more efficient and innovative. Market enabling trends include the opening of market access brought about through free trade agreements. Specifically, new free trade agreements with the UK include provisions for electronic trade facilitation through interoperable systems. Regulation change is allowing for the legal recognition of electronic documents or instruments. The Electronic Trade Documents Bill, currently passing through the UK Parliament, will set the standard for trading partners, including New Zealand and Australian governments, to follow. Moving on to slide 12, the commercial opportunity for TradeWindow remains significant, with rapidly growing markets in supply chain, IT, and food traceability tools. Within a few years, by 2026, predictions are that these 2 areas be close to $100 billion. The opportunity is now, and we're seeing demand grow. I'm on slide 14, and we'll spend the next few slides providing some update on our progress and our growth strategy. We remain committed to our high-level strategy summarized on this slide. We have shifted the emphasis to focus our resources on the land and grow pillars, as we believe this will provide a faster pathway to a self-sustaining model. Unifying solutions into a highly scalable global trade platform remains a priority and can be accelerated pending the completion of the N-Chain deal already covered in slide 7. With regard to the global trade platform, it's important to note that we're already monetizing the platform and seeing the benefits of prior investments. For people, we're focused on productivity and a high-performance culture. Increasing our international presence has been successful for us, as well as making us more efficient. In some cases, where we've had staff resignations, we've been able to backfill these roles in the Philippines, which has helped lower our cost base and improve productivity. On slide 15, this slide goes to the heart of our growth strategy. Increasing average revenue per customer is one of our key metrics. We help our customers fulfill their trade compliance needs before securely connecting them with their supply chain partners through Cube. This slide illustrates the incremental adoption of our digital trade solutions by an exporter as they progress through their digital transformation. On slide 16, we view the adoption of multiple TradeWindow solutions from a customer's perspective. Our solutions help streamline a customer's export operations. At a minimum, we help our customers save time, save money through faster processing and eliminating of errors. Further to this, we provide a secure way of sharing business critical information across a supply chain made up of exporters, importers, freight forwarders, ocean carriers, ports, border agencies, banks, insurance companies, and more. Turning to slide 17, at the end of this reporting period, we had 475 customers using our technology with significant diversity by revenue and industry. We serve many of Australasia's leading export brands. We're proud to serve the majority of New Zealand's red meat sector, having onboarded Alliance in the past year. I'd like to emphasise that these brands aren't just big for Australasia. They're some of the most prolific exporters in the world. Shortly after balance date, we announced a strategic partnership with Buy New Zealand Made to verify and deliver an enhanced supply chain visibility solution for their 14,000 strong pool of licensees. Growing our customer base in Australia and the USA remains a priority. In January, we received approval from the Australian Department of Foreign Affairs and Trade to issue certificates of origin to the Australian market under two major trade agreements. The ability to generate certificates of origin within TradeWindow's Cube is a real boost to exporters in terms of cost saving, efficiency, automation, and all hours of trade to keep globally traded goods moving. It makes Cube even more attractive to Australian exporters. In the USA, our partner Food Chain ID is now onboarded and we're building a pipeline of deals. You'll see on slide 18, we've built a high quality and highly diversified customer base. No single customer contributes more than 5.5% of revenue. Events such as Cyclone Gabrielle in February have highlighted the importance of having a well-diversified customer base. Fortunately, only a limited number of our customers have experienced disruption to their operations. On slide 19, outlines our highly predictable recurring revenue base, which is growing with an expanding market. TradeWindow regards transactional and subscription revenues as recurring since it is driven by highly predictable shipments from significant exporters. The reliability of this revenue is further underpinned by our high customer retention rate. Market trends in all of our focus markets, including New Zealand, Australia, and USA, support increased export and import volumes. I'll now hand back to AJ, who will cover the outlook for FY24.
Thank you, Andrew. I will make a few key points in summary and cover our outlook. We have put our full guidance statement on the slide, and the key points are: we confirm guidance for financial year 24 trading revenue to be between 7 million and 8 million. We continue to focus on our cost discipline and anticipate average monthly cash outflow to reduce from 1 million for the second half to 400,000 for the second half of financial year 24. We anticipate achieving monthly EBITDA break-even by the end of financial year 25 and monthly cash flow break-even in 26. on slide 30, before I move to the Q&A, we have committed our strategy, and we are pleased with our strategic progress, as I have outlined in the presentation. We are forecasting strong revenue growth for the financial year, as we now in a phase where we can be supported by high degrees of recurring revenue. There's also sufficient funding in place for financial year 24, and we continue to pay close attention to ongoing funding needs. And finally, while we make targeted investments to ensure we achieve our goals, we are acutely aware of the need for continued cost discipline and operational efficiency, and we have taken a number of steps in this regard. Thank you for listening to us this morning, and we're happy to take any questions.
Thanks very much, AJ. Thanks, Andrew. Great stuff. Great to hear how it's all going. We do have one question from the audience here, which is, there seems to be a focus on primary agri businesses across your client base. Is there a reason for this? Are there opportunities in other sectors?
Absolutely, yeah. It's really just been a product of what are the main industries in this part of the world. And so for New Zealand and Australia, there's a strong emphasis on exporting primary industry products. We can work with manufacturers of any type, so it's really the movement of goods around the world is what we support.
Fantastic. And just lastly, do you anticipate any change to your overall strategy if Enchain becomes a significant shareholder? Does their vision align with yours?
Enchain is really supportive of our strategy, so they are a partner that will help us fulfill the build of the global trade platform over the next 24 months. And so we see that will just help accelerate our strategy. One of the other elements that they bring is also market access, and so that would bring forward the UK and Europe into our strategy, particularly around revenue generation. And so they would become our sales agent in that market and bring in new revenue streams.
Great, thank you. That's all the questions we have, but I would say to anyone in the audience who, if you're watching the recording and you have a question, feel free to fire that through, because we can get that over to AJ and Andrew. So AJ, Andrew, again, thanks very much for your time this morning. Great to hear how it's all going, and I'll see you again soon.
Thank you, James.
Thank you so much.
Cheers, guys. Excellent. Right, on to our second presentation of this morning then. It is a delight to welcome Stuart Dickinson, CEO of Vista Group, onto the investor event today. Vista Group are specialists in tech solutions for the global film industry, bringing people together to experience the magic of movies and cinema by creating the platform that connects the industry and powers the moviegoer experience. Stuart stepped into the CEO role in April, so a very special welcome to you, Stuart. First time on the investor event at NZX. Over to you, and I'll come back in a few minutes with some questions. Cheers.
Thanks, James, and good morning, everybody. Thanks for the opportunity to spend some time with you today. As you said, relatively new to the business, but very excited to be here, and a great opportunity to talk to you about where we're at as an organisation. So just to notice around the presentation, it is for informational purposes, but very happy to answer any questions at the end of the process as well. So a little bit about Vista Group. We are a vertical market SaaS software solutions provider. So if I unpack that a little bit, we were originally listed in 2014, but the business has been around for a long time before that. So started providing cinema ticketing and food and beverage software across Australia and New Zealand, and we've now grown to become the global leader across the film industry and delivering solutions across that space. As you said before, our ambition is to really help bring people together to experience the magic of movies. So I love, and I'm sure many of you love going to see a movie, and seeing it on a big screen in the dark and being able to experience that with somebody else is a pretty special place to be. And the stories that our movie makers around the world are building today and telling are only getting better and better, and those experiences are becoming more and more immersive. And so the role of cinema is around how to display those and show those. And so our business is built around supporting both exhibitions, so cinema clients, but also the clients that serve them, so distribution clients as well, and that includes all of the studios. So over the last number of years, we have, as an organization, built or assembled through acquisition a whole number of software solutions that serve those two parts of the industry. And so today in the exhibition or cinema market, we look after ticketing, food and beverage solutions, loyalty and subscription, and marketing solutions. And so traditionally, these solutions were very much focused around what I would call operational effectiveness and really enabling a cinema or an exhibitor to transact and do their business. What we've seen happen though, as 2019 and then into 2020 and the pandemic occurred, is that the role of our software has changed significantly. And so our clients today are looking for our solutions to really help them grow their revenue, to optimize their organizations, and to set themselves up as not just cinemas, but broader entertainment organizations as well. And so our software does that and enables those ambitions. For our distribution and studio clients, we deliver everything from box office reporting. So when you see a box office result and hear that a movie's been very successful, we support the reporting of those numbers. We enable film accounting, film distribution, marketing, and audience discovery. And so the thing about movies is that as more and more of them get made, our clients need to find audiences for those movies. They need to be able to market them, make sure that they're showed in the right theaters, etc., or they're shown on the right platforms. So our tools enable that, and by bringing those technology solutions together, we have Vista Group. So today, across our two client bases, so cinema circuit, so locally in New Zealand, when you go to an event cinema or a Hoyt cinema or a village cinema, they're all using our ticketing, food and beverage solutions, loyalty, subscription solutions, etc. And so you can see it and touch it and feel the technology that we use and enable with our clients every day. Around the world, a large number of cinema circuits use our technology, and we provide two solutions, both to very large exhibition clients, but also we have a smaller cut down solution that's focused on independent and art house based exhibitors, so smaller exhibitors who are looking for all-in-one solutions. So we really do cover the entire market. And then across the studio and distribution space, all of the major studios use our technology and solutions. So whether or not it's Disney, Paramount, Columbia, etc., Sony, they're all using our technology to power and enable them to effectively distribute the films and the stories that they're making. So around the world, if I just focus on cinema market share, today we have approximately 51% of the global cinema market, excluding India and China, in what we call the large enterprise space. And so that's with organizations that have greater than 20 screens. And so if you think about that and think about the number of tickets that are going through and being sold to movies, the amount of processing that our software is doing, the number of members and audiences that our software can talk to is significant and massive. And so traditionally the software has been on-premise based. And so what we have done in the past as Vista Group grew is effectively gone out and taken that software, deployed it onto a cinema site, an exhibitor. That software has then been run and calculated and done what it needed to do. The opportunity for us and the journey that we are now on is to bring that together into a single platform. So just in late 2019, Vista Group announced that we were effectively going to move our exhibition solutions to become a true SaaS platform, so to create a single platform rather than have these on-premise solutions. That provides a couple of really key advantages for our clients. It removes the cost, the support, and all of the complexity of having servers and infrastructure on their sites, but it also then connects and enables what we call the digital channels. So things like online ticketing, loyalty programs, etc., marketing solutions. And so by connecting those things up, we have the ability to enable our clients to start to really grow their revenue, to create more strategic advantage, to expand into other revenue areas as well. And so our focus has been and continues to be on taking our existing clients and enabling the cloud, or what we call the SaaS platform journey for them, converting their on-premise solutions to cloud solutions, and continuing to grow those customers over a period of time. So ensuring that we do that is a key part of what we're working on as an organization at the moment. We're investing significant amounts of capital to enable our platforms to work in this way, to become true SaaS platforms. All of our distribution and studio platforms are already enabled in this way, and so this is really just bringing our core exhibition clients along on the journey. And so what that then means is that over the last little while, we've started to announce a number of clients joining this journey. And so we announced in December 22 that Canadian exhibitor Cineplex had committed to Vista Cloud. And then very recently, we also announced that Everyman was on a journey towards this, and so they'd committed to the cloud. We've also got across our marketing platform, which is part of this solution, an ambition to have 100% of our clients transitioned to our new product by the end of 2023. So we're making good progress as we go out, support our clients as they continue to grow and rebuild their businesses post-pandemic, enable them to reach new audiences as the film slate continues, or a number of movies continues to increase, the box office continues to increase. There's an opportunity for us as Vista Group to support our customers on that journey, to grow our revenue as we move customers into this new space as well. What it also does is give us an opportunity to really build a very, very different type of solutions for our clients. So once we have them on the platform, we can start to connect those clients and connect that information together. So earlier this year, we announced a product called Vista OneView, which brings together data and insights from a number of our different clouds, or a number of our different solutions. And it's designed to enable a C-suite, so a chief executive, chief financial officer, to have in the palm of their hand to really understand the performance, not just of their overall business, but down at an individual site or theatre and screen level as well. And so by bringing all of that information together, by turning all of that information into insights, they get a lot more value out of the solutions that we're providing. So as I said, we announced this earlier this year. We're working at the moment with a pilot group of customers, and the aim is to have this product more formally into the market later this year as well. And so as one of the exhibitors said to me, I'm going to live with this solution. So look at it each morning, find out what's going on, or what happened in their organization. And so it brings together all of that data, whether or not it was the box office, i.e. how many tickets were sold, their food and beverage performance as well, because that's becoming increasingly important for exhibitors. So they're moving from just being organizations who are interested in showing movies to becoming much more entertainment focused as well. And so this provides a significant opportunity for Vista Group as we start to enable our clients to work not just with ticketing, food and beverage, and in the core exhibition space, but across that entire entertainment landscape as well. So as cinemas continue to expand their reach and do more, then we will continue to increase our addressable market as well. So as I said before, we announced Cineplex, which is a Canadian exhibitor. A key part of their strategy is to continue to build from not just the film, the theatres that they operate, but also into what they call recreational rooms or rec rooms, which are full entertainment experiences and locations. Vista Group technology will power those experiences and enable some of those experiences as well. So for us, it's a really great opportunity to broaden our addressable market. That's something that we'll continue to be focused on as we move our customers or clients to the cloud, to our new platform. We then enable what it is that they're trying to do from a growth perspective as well. So really, really great opportunity. Where this all starts is when we think about what it is that we would like to watch. And so this is a bit of a plug for one of our local products. And so we have a product called Flix. And so Flix is a cinema and also streaming content discovery platform. So if you're looking to go to the movies, or you're looking to discover where you can watch something from a streaming perspective, then the Flix application enables that. If you're looking to go to a movie, then it will show you where that movie is on locally to you, where that movie is actually being shown, and it will provide an opportunity for you then to click through and actually purchase tickets as part of that platform as well. So all of that is Vista Group technology. All of that is integrated and enabling exhibitors to have access and really understand where audiences are. And so the application is currently available across New Zealand, Australia, and the UK, but it provides, I guess, a really good example of where we see the beginning of a journey for a moviegoer to be, with discovering what great content there is to watch, and then finding out where they can do that, booking the tickets. They might pre-order food and beverage as well. All of that is enabled through our technology, and then when they get into the actual cinema, have that experience enabled for them as well. So in terms of our organization, our focus, as I said earlier, I've been with the business now for just under 8 weeks, and it's really about how do we make sure that we take our strategy, which is well and truly articulated, and execute on that strategy. It's about making sure that we follow our clients, so as they expand into new areas, we'll support them with our technology to do that. But it's also, as I talked about, moving our on-premise customers to the cloud. That enables them to use our technology in a much more strategic way, and then really drive value from that. We're continuing to build new product as an organization, and so we'll be focused around that as well, because that's where we create more value for our clients, whether or not they're exhibitors or also studio or distribution clients as well. In terms of the capital we're spending, we're very focused around how do we make sure that that capital is optimized. It's built around our platform and enabling our platform. So we're looking to spend money when we need to, and making sure that all of those things are lined up as well. We're also very focused around driving efficiency across the organization. And so we've provided guidance around where we expect to be over the next couple of years, and we're continuing to work. And as a new chief executive, I've got an opportunity in working with the team around how can we improve that, how can we ensure that our business is best set up for success, our customers are successful, and then ultimately our investors and people are successful as well. So James, thanks for the opportunity to present and talk about our business. Very happy now to answer any questions.
Cheers, Stuart. Fantastic. Thanks for that. As a reminder, to ask a question, please do so via the webinar panel. Yeah, great to hear some of those validation points. I don't think I've heard of customer feedback saying I'm going to live in this in relation to your
Yeah, that's pretty
solution. That's,
exciting.
I think you know you're on the right tracks when you hear that. We do have one question that came through earlier, and it is just in relation to market share. So do you plan to increase market share further, or is your focus around consolidating your existing position via the SaaS platform?
So we'll be focused on both. So there is absolutely an opportunity for us to grow market share. As a global organization, we have capability in each of the markets. There are still, as I talked about before, 51% of the market as we were at today. And so we'll be looking to take market share as well. And those clients, when we sign new clients, will go straight onto our new SaaS platform as well. So we kind of get a double benefit of doing that. So growing market share, but also making sure that we look after, continue to support our existing client base on their journey as well.
Great stuff. We don't actually have any other questions right now, but if we do get them, Stuart, we'll fire those through to you after today. So thanks once again, Stuart. Enjoy the rest of your day and see you again soon on another investor event. Cheers.
Thank you. Thanks for the opportunity. Cheers.
Bye-bye. Fantastic, thank you. And then lastly, we move to now, again, a warm welcome to our next presenter. Jaime Monaghan is CFO of PaySauce. Hi, Jaime. PaySauce is a SaaS fintech platform providing solutions for people at work in 14 jurisdictions across the Asia Pacific region. With PaySauce, employers are given the technology to digitally onboard, pay and manage employees from any device. Great to hear from one of our listed fintech businesses this morning. Jaime, over to you. I'll be back in a few moments with some questions. Thanks.
Super, thanks very much, James. And yeah, thoroughly enjoyed the other two presenters as well. So thanks for sharing your insights there. Yeah, PaySauce is a payroll company at heart. It's cloud-based payroll. We're based in Lower Hutt in Wellington. We're currently providing payroll services to micro businesses, being our target audience, and we define them as those with 1 to 5 employees. We've taken a strategy of targeting those the micro businesses, particularly in the dairy sector, has been our acquisition strategy so far, and we're expanding that out in New Zealand. We'll talk a little bit about that shortly. So the usual disclaimer applies. We're not giving financial advice, so as per the other presenters. So a bit of a business update in terms of where we've come from. So we're going to talk mainly about the results to March 2023, being our financial year that's just gone. So key highlights from the year, and again, repeating some of the SaaS metrics that have been mentioned with the previous presenters. But our highlights for the year really have been in relation to our revenue growth. We're still an early stage company, still looking at getting that targeted growth coming through, and having increased that recurring revenue so to $5.7 million is up 68% this year, which is obviously a good result for us. We're also looking at the customer value growth. So there's a slide later on that I'll show you how that customer value growth comes along. But another key SaaS measurement, and taking that total customer lifetime value and increasing it by 77% this year. We're also doing that in a sustainable way. So one of the things that we do is we make sure that our growth is a sustainable growth. We're kind of masters of our own destiny as opposed to growth at all costs. So we've taken a very conservative approach to raising funds and investing that into the right things to make sure that we get sustainable growth going forward. And we've introduced a new measure this year, which a lot of investors are talking about, being the rule of 40. And that really kind of takes the growth profile and the profitability profile and combines them into a metric. And a rule of thumb is if it's above 40, it's good. If it's below 40, you've still got progress to make. So we're scoring 67 on that metric, which is pleasing for us. And we've also been recognised in a few awards. So we've got the High Tech Awards coming up for this year. So end of June, we're hopeful to get some results in that space. So looking at those in a bit more detail, the recurring revenue growth, we've had 68% year on year, as I said, up to 5.7 million. And really pleasingly for us, we've achieved that across all measures. So we've both grown the customer portfolio, we've increased the value that we're getting from each of those customers that we have. and we've also increased the interest earned on behalf of customers. So as a PAYE intermediary, which basically means that we deduct the PAYE from each of our customers and pay that across to the inland revenue, we're entitled to earn interest on those funds. So that component has obviously benefited as well with those customer funds increasing, but also the increased interest rates coming through as well. So looking at the customer lifetime journey, these are typical SaaS metrics. A new customer joins PaySauce, we pay an acquisition cost to acquire those, and on average we're paying $500 for each customer that we acquire. Each customer then pays us a monthly subscription, so $81 a month on average over the last 12-month period, gives us that recurring revenue. And with that recurring revenue, it's that predictability component that we've spoken about in the last couple of presentations as well, that enables us to keep predicting that revenue going forward. We then get a cost to serve those customers. So we're a cloud-based service, so we have hosting costs and also our customer support team. So customer support is a key component of our service. Our customers love us and keep coming back to us because of that quality of support that's available. So it's a SaaS service, but with human support. So our customers like to know that they want to be able to do it all themselves. They're the small kind of micro businesses, owner-operators that are running their business. But they like to know that when it does get hard, there's somebody on the end of the phone that can support them and talk them through the problem. So that model works really well for us. That then generates a margin for us, and when you extrapolate that margin out and you look at the length of time that a customer stays with us, we've got very low churn rates. So within our sector that we're in, within the payroll services and those micro businesses, our customers don't find an alternative solution. Our churn rates come because customers no longer have staff, and we get great customer testimonials of people saying that they love the product and they're only leaving because they don't have staff anymore. So that's a great accolade for us. And when you extrapolate those metrics out, our average monthly churn rate of 0.75%, payroll is very sticky, so it means that on average customers stay with us for 11 years. And what that means then is you multiply all those numbers out and you get a total customer lifetime value of $7,800. So it's a 16-to-1 ratio on that acquisition cost that we've got, and then you multiply that by our customer numbers to get that total customer lifetime value of our existing portfolio. So just a SaaS metric that we like to refer to and show the total value of our customer book in those SaaS metrics. Moving on then, looking at that sustainable growth and the Rule of 40. So again, it's the profitability measure and the growth measure combined. So you can see the two components of that on the graph there and see the progress that we've made against that. So as a relatively new company, we've fought hard to get to that self-sustaining position. Being self-sustaining from an operating cash perspective was really, really critical to us. We achieved that in the last quarter of the previous financial year. We've been able to maintain that level and be really deliberate about where we invest going forward. And that's been reflected in that Rule of 40 measure coming through, where we're currently at 67%. On the awards, again, like I said, finalists for the New Zealand High Tech Awards and the Wellington Gold Awards last year. The New Zealand High Tech Awards is a joint entry with BNZ. So BNZ have provided us with a lending facility where we're able to issue our Pay Now feature. And Pay Now is a solution where we use the tech solution that we have. So we have our payments component embedded into our payroll application, and our customers' employees are able to access the wages that they've earned before payday, and we offer that service for free to all of those employees. And really the reason for that is that we've got a shared dislike, shall we say, for payday lenders and people who exploit those who have the least amount of available funds for themselves if they're unable to live week to week. It's not a great position to be in, so we use the tech that we have to help solve that problem, and we make no profit out of that at all. And BNZ also provide us the facility for free. So it's a feature that we're very proud of, and we've estimated that we've saved our customers $2.2 million, the employees, over the last 12 months, just by offering that as a genuine solution for payday lenders. So we're very, very proud of that feature. Looking at the strategy that we've had and reflecting back on the last 12 months, our 4 key strategic priorities are to reinvest for long-term growth, obsess over our customers, win-win-win partnerships, and awesome people. So just a wee bit more about those in turn. Reinvesting for long-term growth. Since we've become cash flow neutral from an operating cash perspective, we've chosen to then take the profits, rather than generate profits coming back in to distribute, we've taken those profits back into the business and deemed that to be the best return for our shareholders at the moment. So really reinvesting back into the product and development team, reinvesting back into our R&D side of things, and you can see on the slide there that the percentage increases that we've put in that space. So that's where the profits that we're generating are going back into the business. And we're also delighted to be building a prototype at the moment for doing a pilot into the Australian market. So again, taking that expertise that we have in payroll for the micro businesses, and in particular in that dairy sector, where we currently have 1 in 2 employing dairy farmers using our software, knowing that industry and moving that across and trying it in another jurisdiction. In terms of win-win-win partnerships, we want to be experts in the bits that we're experts in, and we want to partner with people who are experts in their areas to make sure that the client ultimately wins. So we've reached out to a few new industries this year, plumbers, builders and hospitalities being key 3 sectors, and we're looking at repeating the wins that we've had with our existing partnerships like Dairy NZ, Dairy Women's Network, Federated Farmers, to really get that market penetration and support the events that these industry experts run, so that we can be the payroll experts in that space for those target markets. We've also partnered with Chartered Accountants New Zealand, Australia, New Zealand rather, and that's really to get into the accounting distribution channel. So when our target market are looking for advice, they generally go to other players in the same market, or they go to their accountant. So partnering with those accountants and making sure we've got really strong industry connections there enables us to distribute that product really, really well. We've also got some new sponsorship opportunities in the last year. We've been a supporter of Taranaki Rugby Football Union for a while in that rural connection. We've also got back a short sponsorship of the Wellington Lions this year, which is pretty cool. And we also have an employee share scheme. So one of the things that we do really well is we partner with our existing employees, and we make sure that there's alignment there in terms of objectives, so that each employee of PaySauce can benefit from the success that we have. We've also got obsession over our customers is a key pillar for us, and really listening and understanding the needs of those customers, being there when they need help. We know that payroll is not something that customers can put off till tomorrow. If you've got a problem with payroll, it's urgent, it's right now, and that customer support for those customers is absolutely critical, not just in terms of servicing them, but also listening to what their unique needs are, understanding when we go to Australia that we can't just assume that an Australian dairy farmer is exactly the same as a New Zealand farmer. So we've been over there, we're listening, we're learning, we're trying to understand what their unique needs are. And when we go to Australia, the calculation of the awards that they have over there is different and complex, and we'll build that into our rules engine to make sure that we're in a position to do that expertly once we go over there. And the last one then is the awesome people. So this year we've created a new people experience function. We've made sure that our employees are a top priority for us, recruiting, retaining, and growing the talent that we have within the organisation is really, really important. And we've also got a very diverse workforce as well. We've got diversity not just across gender, but across race, across first language, religion. We've got a very diverse workforce for the size of the company that we have. So moving that on then into what's that delivered for us. You can see the stats on there in terms of the growth that we've had, and in summary, all the key metrics are green. So we're going in the right direction across the board. We've managed to increase our gross margin, and part of that comes from the scalability that we've built in. So that long-term growth has really enabled us to invest in making sure that we're building in efficient systems going forward. And we've reduced that net loss down from 1.3 million to 558, and at an operating level, that cash side of things, that's the one that we keep a key eye on, is making sure that operating cash flow is positive now going forward, so that we can reinvest in for that long-term growth that we spoke about. Looking at the results coming through over the last kind of couple of years, really curbing that cost increase whilst inflating the revenue line increase. So 66% year-on-year revenue growth compared to a 33% year-on-year expense growth. So again, it's not growth at all costs, it's targeted growth in terms of where we want to invest our dollars back into the business to make sure that we're really focused on driving revenue and top line growth coming through. Go through. So yeah, that's it in a nutshell. I'm very happy to take any questions that you've got, and yeah, talk about some more.
Thanks very much, Jaime. I love the awesome people. I think that's a sound bedrock for any successful business. So great to see that, and also obviously all the best for the upcoming High Tech Awards. Again, I'm reminded to enter your questions via the Q&A box, and even if you're watching this after the live session, do send those questions through. A couple here, a little bit similar on sort of international expansion. So I'll read them both out. Does being based in New Zealand have any limitations in terms of expanding into overseas markets? I think that's probably a nod to Australia. And the second one is, do you have plans for further international expansion? So maybe just if you want to reflect back on your comments there.
Yeah, sure. Great questions. So yes, in terms of being New Zealand based, you know, we've obviously got a very big next door neighbour. Next door is a very big market. We've been over there, we've researched it, so it's actually very easy to enter. One thing that is important there is those personal relationships. So you can't just assume it's the same, jump on a plane across the ditch and make those assumptions that it'll all be exactly the same. You do need to get in front of them. I don't think that being in New Zealand is an inhibitor. I think that's a real enabler. We're seen really, really well across the world as a tech solution to a lot of things, both agri-tech and fintech. So I think that's working really well for us. I think that actually works in our favour. Also, being a SaaS company, with the way that our solution is architected, we can just replace the payroll rules engine with, you know, replace New Zealand rules with Australian rules. So that works well. We've also got, you know, in terms of other aspirations that we have, we're definitely looking at global expansion. Asantha, our CEO, talks about us being to payroll what Xero is to accounting. And that's absolutely on the cards in terms of, we're still very, very early in our growth journey, but we've got absolutely global aspirations. And our biggest challenge at the moment is saying no to some of the really cool opportunities that come in front of us, because we've got to be really targeted and really deliberate about where we expand. We are still a relatively small team, but the opportunity is massive and it's really exciting.
Great to hear, some great ambitions, fantastic. Okay, that's all the questions. Anything we do get subsequently, we'll obviously fire through, Jaime. So thanks to you for today. Great presentation. Thanks very much. And that concludes today's investor event. So thanks very much to all our presenters and indeed to our audience. Just to note, we've got our next presentation on the 19th of July. Welcoming three issuers, and indeed we do have presentations or investor events, I should say, every couple of weeks in H2. So we've actually got 25 issuers already booked in for those. So, and again, a great chance to hear from the listed businesses here in New Zealand. Thanks very much, everybody, and have a good day. Bye bye.